This is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value and for planning your eventual exit from the business. We want to help you build a business that is sellable and then exit successfully on your own terms and conditions. In growing your business and building value, bank lending is always a consideration and very often a requirement. We currently have a client who's considering a sale to co-owner and children, and bank lending will absolutely be a part of that plan. You may be in process of selling your business to a third party, to an ESOP, where bank lending is going to play a role in facilitating the transaction, or perhaps you've calculated that growing your business with a goal of with a maximum sale price will require an acquisition or more, and rather than trying to continue to grow organically. In all these examples and more, bank lending is often a factor, and so for that reason, we have Jenn Loges of One Degree Capital back with us today, and we plan to have her with us regularly because bank lending is so critical to exit planning and building value. And so our topic today is a banking update.
Pat, let me go ahead and give a little background for Jenn. So with her husband, Rod, Jenn is co-founder and COO of One Degree Capital. She has over 18 years experience in business financing and has served over 5,000 clients throughout the nation. She was with us a few months back, very popular guest. She also was the star of our Facebook Live events that we did to help business owners make it through the COVID-19 crisis. She was fantastic. So Jenn, it is always great to see you. Welcome back.
Thank you, guys. It is always great to be with the two of you. Again, as I have said before, I think the content that you provide to business owners, that really helping them along with this critical piece of it as they're preparing to sell their business, I think is so helpful. And so it's great to be back. You guys always have great content, not just what I bring, but all the other content that you have on your podcast are awesome. So thank you. Thanks
for saying that. So Jenn, I'm sure like me, you've been burning the candle at both ends, helping business owners walk through this. Right now, I guess it's the PPP forgiveness process that seems to be, like everything else, changing almost daily. They came out with some new comments, I think just last night. So we're very grateful that you would take the time to be with us again today.
Yes, and I want to start this off by saying I am not going to spend 30 minutes talking to you all about PPP. We hear about it enough. We're going to talk about some other stuff.
Fantastic.
What I really wanted to talk with you all and your listeners about today is really kind of the state of banking and how, what it looks like right now. We do a quarterly, our company, One Degree Capital, does a quarterly state of banking report. We're gearing up. We're getting to this end of the second quarter. We're gearing up to release an updated version of that. And so this is really, your listeners are kind of getting a sneak preview as to what the report is going to have in it as the month ends. But that's really kind of what I wanted to focus on this morning, as I know that's kind of top of mind with a lot of your listeners. So what I wanted to delve into is, I think really the big question, Pat and Walter, I'm sure that your clients have as well, is are banks lending outside of payroll protection right now, outside of this PPP? If you contact any of the banks, they're going to tell you right now that yes, they're continuing to underwrite for loans both within the CARES Act and outside of it. The CARES Act includes more types of loans than just payroll protection, although that's the one that's been consuming the media attention for the past 3 months, really. Within the CARES Act, there is the payroll protection. There is still funding left in that program. I won't get into all the reasons why, but there's funding left in that program. So if you haven't done it, that is still an option. There is also the traditional SBA 7A loan program continues to be offered. There are some enhancements with that under the CARES Act. There's some nice ones, like there's payment forgiveness options available even if you take a new 7A loan right now. If your loan closes before the end of September, you actually get the first 6 months payments forgiven. So You have to meet all of the other requirements for a 7A loan. It does have to go through traditional underwriting. We'll get into that in a minute. But that is an option that's out there. It can be pretty attractive as a way to get part of the loan that you don't have to pay back. Outside of that, also within the CARES Act is the Main Street Lending Program, which hasn't gotten a lot of press until lately. And one of the reasons it wasn't getting a lot of press was because when this came out, it was probably the worst named program out there. The Main Street Lending Program, the loan limit, the minimum loan amount was $1 million. That's not really Main Street for a lot of the Main Street businesses that we know. They've continued to chip away at it and improve some of the terms of the loan. Just this in the past week, they've lowered that now to the minimum loan amount is $250,000. The challenge is these are only 5-year loans, so you can kind of do the math on what that payment is going to be like. So at a minimum of $250 on a 5-year term, the rate is LIBOR plus 3 and it's adjustable. So you do have to be creditworthy. These are not for very small businesses. These are for businesses. They're targeting that your loan amount would be 3 to 4 times your EBITDA. So this is for more established businesses that could take advantage of it. There's also some pretty hefty reporting requirements in that would really rule out a lot of the smaller businesses, but it is an option. There are still banking options outside of the CARES Act for conventional loans, conventional lines of credit. Banks will tell you all day that they are still underwriting for these, that they are taking applications on those. Probably the biggest thing that I want to let your listeners know is that, yes, because your bank is taking an application doesn't mean that they're approving it. There's been a huge swing in loan approvals this quarter. Bank approvals prior to COVID were at an all-time high. So one of the metrics, one of the lending indexes that we track, bank approval rating at the big banks, so you think the big box banks that everybody knows, their loan approval rating in February was just over 28%. So that means 28% of all applications that they got in were approved, which sounds atrocious in and of itself, but that's where they were. And that was an all-time high. Big banks are very risk averse. That number in April plunged to under 9%. So for every business that was going to a big box bank to try and get a loan approved in the month of April, less than 9% of them were actually getting a loan approval. And that doesn't even count as to whether that loan wound up closing, because a lot of times a business can get an approval where they just simply can't meet the terms.
So, yeah, I was going to ask you how, and I think you're kind of getting into it right now. How's the bank underwriting changed in response to these current issues? It sounds like it's getting tougher to get a loan for other purposes, such as, well, some of the things that we might do with clients. Is that right?
It is, definitely. The reality is that, for all of these government programs that are out there, the government is guaranteeing these loans, but the bank is still assuming a risk. And banks always will underwrite for that risk. One of the biggest challenges that they have right now is the future is very uncertain. So they're trying to figure out how to underwrite for these loans, and they're coming up with giant question marks. And if there's one thing that banking underwriters don't like, it's giant question marks. So you see that what you're finding is when you are getting those approvals, so if you're one of the small fraction that are actually getting loan approvals, you're finding that you're being expected to put more skin in the game. They're wanting, whereas before maybe you had to do a 10% down payment on a loan, now it's 20, sometimes 30%. Where before you didn't have to put as much collateral up, now they're wanting additional collateral to backstop the loan. So everything when your request goes through underwriting, everything is about assessing that risk, and the underwriters look at what are the options if things go wrong. Certainly, one big thing that's affecting people right now in underwriting is if they have a payroll protection loan, yes, it is forgivable, but it's not yet forgiven. So those loan terms that you signed that had those really high payments on it, that you signed it anyway and said it's okay because it's going to be forgiven, that debt service is actually being factored in to your loan underwriting if you're going to apply for a new loan. And that is a huge reality check for a lot of businesses who know that what they signed, there's no way that they could afford making the payments on. We talked a little bit about how big banks are doing. I do want to point out that if you work with the smaller banks, if you're looking at more regional banks, they have slightly better approval terms than big box banks. Before COVID, back in February, they would approve roughly half of the business loans that came to them. In April, that's now down to around 12%. So it's had a huge impact there. Alternative lenders, we all talk about the alternative lending environment. So these are non-banks. They're not FDIC insured. They have different lending rules. A lot of times they're funded by private equity. They have the best approval rating of anything. Before COVID, they were at about 56%. Post-COVID in April, they were approving about 15%. So still the highest certainly of anybody. But the challenge is with alternative lenders, if anyone's ever gone to them, you know that the risk is greater. So they're going to approve more, but it's the terms. It's going to be much higher interest rates than if you're working with traditional banks. Credit unions are always kind of iffy with businesses. A lot of credit unions are focused on specific market segments. They're usually consumer based. They do some business loans. They're kind of coming in the middle. They approved about 39% of their loans pre-COVID, and then after that they were at about 18%. So there's some options there. It's definitely if you're looking to try and get a loan right now, the smaller banks are going to be the way to go. We just need to wait and see how that plays out, because the underwriting on all of them, even though their underwriting standards are a little bit different, their risk tolerance right now, there's still a lot of those types of question marks that you have.
So Jen, would you recommend to a business client who has a PPP loan and they're anticipating having most or all of it forgiven, that they kind of hold off on pursuing traditional bank financing until that happens?
Yeah, if it's at all possible, the best thing to do is to wait. And that's one thing that when we work with our clients, when we're evaluating them for what type of loan or what type of funding to get, one of the factors that we always evaluate is do nothing. Sometimes that's the more prudent course. And certainly now, if you have a funding need and you're looking at it, but you've got some flexibility as far as the timing of it, it will be best to wait until you have that payroll protection funds forgiven, particularly if you have a larger amount. Because unless you can look at it and you can work with an advisor to weigh things out for you and see kind of where your debt service falls, factoring that payment in. Certainly, if having that payment in there, your debt service ratios are still fine, then yeah, keep going forward and go through with the bank. You're probably not going to have too many issues. But it's an issue if on paper you can't afford that payment. A bank's probably not going to give you additional debt piled on top of that.
You can bash the SBA all you want, but I was actually kind of impressed given the volume of loans. I mean, a lot of our clients, they applied, they got their grants, they got their PPP loans, they got their EIDL loans. I mean, it was actually, I'm sure there's a lot of horror stories, but all in all, I thought it was actually pretty good. Oh,
sure. Yeah. And I think it started, wherever you started from, pretty much dictated how easy or difficult it was going to be for you. I think the ones who suffered the most were probably the ones who needed it the most, which is the very small businesses who got a late start being able to apply anyway. And I think a lot of the bigger box banks were focused on traditional businesses and not so much on, say, Schedule C filers, which probably is not any of your clients. So, but yeah, for the types of clients that you would have, definitely by far and away, once the banks got into the groove of it, things got smoothed out. One thing I would say is the SBA throughout all of this, SBA and Treasury and Congress, specifically the Small Business Committee in the Senate, they were listening. So they did appear to be responsive to, there were a lot of complaints. This program was not perfect at the launch. Many would argue it's still not perfect now, but what is? But I do think that for all of the associations, for the groups that were out there that were saying, hey, this specifically is wrong with it, this specifically needs to change, we did see a lot of those changes happen. And I think that is what's helped smooth things out a bit for some of the businesses.
Let me ask you just kind of maybe get your opinion on something. So, we have a number of clients who right now, it may be difficult to get a loan, maybe because they have the PPP in place or whatever the reason might be. And they don't need a lot of money. Let's say they need a couple $100,000. And it can be very tempting for them because mortgage rates are really good. It can be very tempting for them to refi a personal asset, even their residence.
Yeah, it's tempting. It's always tempting. We saw this in the mid 2000s when, before when the boom was going on with the real estate market. Yeah, a lot of people were taking out Helocs and doing all kinds of things with them. There is risk with that, obviously. If you take that out, if the real estate market, gets shaken by what's going on, you do run a pretty significant risk there. I would say this: to me, there are no absolutes. I am never one to say that using a HELOC to fund your business is a bad idea. There's just no blanket statements like that because every situation is unique. There may be times. Actually, we have a client of ours who's doing that very thing. They have a property that they own free and clear. They're taking a HELOC out on it to use to help fund their business over the next few months. We've looked at all the business models. Ran all the what if scenarios, and it still seems like a prudent choice. So there are no hard and fast rules. What I think is that you need to make sure that you have someone who is walking that thought process through with you. Don't just don't just go run out and get a HELOC and say, I'm going to use this without having thought all of the possibilities through and truly weighed them and made an informed decision. That's the same with, some businesses. You can borrow from your IRA. And there's with the CARES Act, there are some advantages to doing that now where there's some of the penalties and things are being waived right now. So that is an option. One would argue is that really the smart thing to do right now, given the way that the market is going? There's no absolute with it. I think it's something you sit down, you weigh the options, and you make that informed decision.
Jenn, so if you were to just give a summary characterization, if you will, of the overall banking finance environment currently as it pertains to small business owners, and then where you think it could be in another 6 months.
Because I have the crystal ball, right, Pat?
I have the crystal ball and do the forecasting here. And maybe we even extend the crystal ball from 6 months to 1 year. And let's just say for businesses that, that have less than 35 million in revenue. So the truly small businesses, what would you say?
I would say kind of what we were talking about before is, look at what your true needs are and have someone look through that with you. If you don't need to act right now, and by act, I mean, if you don't need to make that purchase, you don't need to look for additional working capital. If you don't have those needs right now, the best thing to do is wait all of this out. If you're looking at your financials and you're realizing that something has to change or something drastic will happen, then you need to look at what the options are. Certainly, where you have your existing bank relationship is a good place to start. It can also be a very frustrating place to start. The reality is a lot of people choose their business bank by one of two reasons. Either it's where they bank personally, or it's the bank right across the street from wherever they have their office. And a lot of times when you get into these types of strategic decisions about where to do the right banking for your business, those two factors, the proximity and where you have the personal relationship, don't factor into your business banking. So crystal ball wise, I would say I think it's, things are really at their lowest point right now, especially when you look at how they were back in February as compared to April, which is the most recent data that we have. I do think that it should be poised to get better as things start to reopen. They're going to be underwriting. Banks are always going to be looking for return on investment. So they have, there's deposits sitting there. They're paying out interest on those deposits. They've got to have that money working for them. So they will be looking for ways to put the money out there. It's just the challenge is going to be that as business owners, we need to be prepared that the banks are going to ask us for more. And so right now, just keep that in mind that you're going to need more than you did just a few months ago in order to get a loan.
All right, very good. So in closing here, any final words of wisdom, any questions that we should have asked that we didn't today?
If you're declined by your bank, what are the alternatives? And the one thing, again, as I said, kind of every bank is different. If you're declined by your bank, you can certainly be shopping for another bank. Do keep in mind there are non-bank lenders. There are those options out there, which is certainly something to consider. There are things outside of even, just traditional lender or non-bank or bank lender. There's other ways to get funding for your business as well. I think the best thing to do is to keep in mind when you talk with bankers, no matter what their title is, their job is to sell you on their bank. So they're compensated on loan volume and deposit accounts held. So you really want to make sure that you've got those advisors, whether it's your CPA, whether it's your attorney, whether it's someone who's there, who's on your side, who is looking at this and helping you to make those informed decisions. Company like ours, One Degree Capital, we're an independent banking advisor. So we're bank agnostic. We don't work for any particular bank, and the banks don't pay us to tell you that they're great. So we're fee-based. We work right alongside with the business owners to help them make those decisions. So something like that would be, if you have to make a decision, make sure you've got someone in your corner helping you evaluate those options, no matter who they are. Final option, as I said before, is wait it out. The situations change. If you don't need to do anything now, don't, and hang on, and things will settle down.
Fantastic. And so is there anything that you and Rod and One Degree Capital have going on that you want to promote today?
Yeah, no, I appreciate it. We do have our YouTube channel at One Degree Capital. So be sure to check us out on YouTube. We are posting additional videos as things progress, both with the CARES Act funding, and we're also expanding outside of there. We also do repost these podcasts, so you can find these on there as well. And books that we're writing, maybe when things settle down a bit, we'll have some books going on. But we've been very blessed. Every business that came to us for help with their payroll protection funding, we were able to get them the funding that they needed. So we've been very blessed, but we've been also very busy.
Yeah. And then lastly, please let people know how they can reach you if they want to.
Oh, sure. You can always visit our website, onedegreecapital.com. On YouTube, you can just search One Degree Capital. And also on LinkedIn, you can find me as Jenn Loges.
Jenn, thanks again. It's always a pleasure. We'll have you back in a couple of months. It's not going to get any less interesting in the next few months, I don't think. So it'll be fun to have you back probably at the end of the summer.
Most definitely. Thanks, guys.
Yeah, and I would just encourage listeners to take a look at the One Degree website. A lot of really helpful short videos and everything. Really, really fantastic. Great seeing you, Jenn. Always enjoy speaking with you. And
listeners, if you want help in maximizing the value of your business or planning for your eventual exit, you can reach Walter at 301-951-9090. And you can reach me at 301-859-0860. You can also access resources at exitreadiness.com, grfcpa.com, and nslp.com. Thank you for listening. And until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.